All right. Well, welcome everybody. I see a lot of familiar faces around the room. For those of you that I haven't had a chance to meet yet, my name is Chad Harmon. I am one of the partners here at A&I Wealth Management, and it is my privilege to moderate today's Lunch and Learn event, which is going to be our third quarter market commentary, brought to you by our research partners at IM Global Partners and Athena Invest. Holy cow, what a day. It is not a sea of red or a sea of blue that has taken over our state. It is a sea of white. So we are thankful for those of you who braved the roads and got here to join us in person. For those of you who are joining remotely on Zoom, for protection of your privacy, we have made you invisible and put you on mute, but it is not because we don't want to hear from you. So as questions pop up during today's event, please use the chat feature at the bottom of your screen. We will be able to see those questions coming through, and we blocked off plenty of time at the end for a great Q&A. I think it'll be a fun conversation here today. Let me introduce our speaker, Mr. Karl Frank. So Karl is our acting president of our firm. He is my business partner, which I'm very thankful for, and he is really the thought leader of our investment committee. The thing I think I appreciate most about Karl is truly his unquenchable appetite for knowledge. I don't know if I know anybody that consumes information the way that this guy does, and the reason for that is he's constantly trying to understand this crazy world we live in and constantly trying to make sense of the financial markets and better our team. And I think that will be glaringly obvious as you hear him speak today. Very fun time for us to be talking with everything going on around our country last night and into today. So again, for those of you in person, if questions do pop up, use the scratch paper that we provided for you, and we'll make sure we get everything addressed at the end. Without further ado, I'm going to hand things over to Mr. Frank. Good luck.
Thanks. Yeah, thank you, Chad. It's great to see everybody. Again, thanks for making it in for today during this really crazy weather, and all of you at home, and those of you who are going to watch it in the future days. I'll talk about three things. I'll talk about the market, I'll talk about the economy, and then we'll give you some forecasts. And we're going to use three research firms. This is the first time we're adding a third to these presentations. So yeah, it'll be IM Global Partners, it'll be Athena Invest, and we're also going to use some great slides that are from Capital Group, which I hope you find captivating. So to remind you that we do accept new clients. So if you have any friends or family who are looking for assistance, please reach out to us and we will find somebody here who'd be more than happy to help your friends free of charge. So if you're at home, you can scan this barcode. If you're here in the room, you can scan the barcode. It takes you right to our website with a nice web page that describes what we offer. So please take advantage of that. We'd be super excited to have your assistance. Holy cow, the past few days have been pretty interesting. I'm sure that you would agree. I don't know if anybody's felt any insomnia or heightened emotions or even mood disorders or anxiety or depression or elation. Yeah, that time change was rough. Oh, and there was this other thing. Right? This other thing that happened just yesterday. Yeah, that's been amazing too. Well, this past year has been one of incredible stress. We called it the wall of worry. This image that you see on the screen was actually made by artificial intelligence when I typed in wall of worry several presentations ago. And it hasn't lightened up, has it? And certainly now the election is behind us. We can all be hopeful that the year ahead of us will be less stressful than the year behind us. But look at all the other things that are written on the wall here, and you'll find there are all sorts of wars, all sorts of natural disasters, all sorts of things around the world that can cause us to be anxious. And I hope you'll find that today's presentation is optimistic, as we have been for a long period of time. And I think you, as an investor of ours, are rewarded for that. I hope you find that be true still. All right, let's dive into the market. Now, I will have time at the end for questions, so please do type those in if you're at home. And here in the room, go ahead and write them down or just ask me at the end. But I want to get the facts straight. So some of these slides I will be reading. And so despite some intra-quarter volatility, the larger cap S&P 500 index reached new highs in the third quarter, gaining nearly 6% just in the third quarter, and to hit new highs of over 22% year to date. Notably, there was rotation out of the large cap companies and especially out of the technology companies into smaller cap companies and into value companies. So large cap value gained 9.4% in the quarter, outperforming large cap growth, which only gained 3%, which is still a fantastic quarter. And small caps rose 9.3% during the quarter. So equities had a great third quarter. Outside of the U.S., developed international equities gained 7.3, finishing ahead of that S&P 500, the local companies. The 3-month period, and emerging stocks were relatively quiet for most of the quarter. They rose sharply in the last week of September when China announced their biggest stimulus, perhaps in history, definitely in years. Emerging stocks finished the quarter up 8.7%, and China grew up 23% in a single week in September. It was so good. We don't depend on our government for our happiness like the Chinese do. Thank goodness, right? Within the bond markets, returns were positive across most fixed income segments. The benchmark 10-year Treasury declined from 4.3% return to 3.8% during the quarter, so that was volatile. It's up since then. I think the last I looked just a few minutes ago, it was 4.4% is the date. We were recording this on November 6th. The aggregate bond index gained 5% in just the quarter. And then high yield bonds were up 5.5. So thank you for letting me read the stats to get it all straight. I'll describe all of those in more detail here real soon. This is a new slide for this presentation. I'm actually exposing you to some of the behind the scenes work that one of our research partners does, forecasting, making forecasts about the future. And so IM Global Partners, we've worked with them since almost the beginning of our firm. Our firm was founded in 86, and so were they. Shortly after I started helping out Stacy's parents in 1996, I latched on to this firm, their predecessor, and liked their research. Let me share with you how they view the world. IMGB believes inflation has peaked. Over the near term, inflation is going to trend lower towards the Fed's long-term goal. The economy is relatively healthy, according to IM Global Partner, and a soft landing is their base case. So that's as optimistic as IM Global Partner has ever been in our history working with them. Their global equity allocation is neutral overall, balanced from a growth, value, and blend perspective. That's all good news. Within U.S. equities, large cap growth continues to outperform, driven by impressive earnings growth related to artificial intelligence. More on that in a minute. IM Global Partners thinks there are opportunities outside of just these large cap technology companies, so they are positioning their portfolios accordingly. U.S. core bond yields have increased and now offer more attractive return potential and increased downside hedge. And credit remains attractive as well as with yields in the upper single digits. And they maintain positions in alternative investments. We're going to talk about all of these here in a minute. That's as optimistic as IM Global Partners has ever been, what I just read to you behind the scenes. The U.S. economy remains in good shape. Overall, IM Global Partners' view is that economic data remains generally healthy. For example, the real GDP for the second quarter was up 3%. The most recent data on the third quarter was up 2.8% back-to-back quarters. Significant growth in the U.S. economy. The base case scenario for soft landing continues to be good. So you can see on the bar graph in front of you, lots of bars above the line showing the economy from the high level is growing. Inflation continues to moderate. The IM Global Partner view is that since early this year, inflation has been trending downwards. They've been forecasting this. It has trended down. Decline in inflation gave the Fed the confidence to lower the Fed fund rate by 50 basis points. That's 0.5% in September. And if you're following the Fed, and I hope you're not, my gosh, I hope you have a life, they'll meet very soon as tomorrow, and they may lower rates again tomorrow. This is all good news. The Fed rate of 0.5% decline in September was the biggest since the global financial crisis of 2008. It was a huge move. And on the chart that you can see in front of you, lots of years across the horizontal, and the rate on the left-hand side, the big orange bars are recessions. And you can see that after every one of the times in the past when the Fed has raised rates, and they raised rates as quickly as they ever had at the rate of increase most recently, has always preceded a recession. Again, I'm Global Partners for years has been less optimistic than they are now. They do believe that we're going to have a soft landing, meaning there won't be a recession here in the future. So outside of that emergency pandemic rate reduction, the last time Fed cut rates was 0.5%. And that pandemic, you can see, led to a recession that if you blinked, you missed it. It was so short. This, again, is all good news coming from one of our chief and longest lasting research partners, IM Global. The Fed has now shifted their position, their focus. So since the Fed's July meeting, inflation has declined faster than the Fed anticipated, while the unemployment rate rose more than expected. With inflation less of a concern, Fed's primary focus is now on full employment. So the charts on the left-hand side, you can see the Fed is now focused in September on inflation. That's an increased risk, the upward arrow. And the chart on the right-hand side, less of a risk on inflation. The Fed sees a growing risk of the unemployment rate and a more balanced risk to inflation by moving their focus to labor market, hoping to safeguard a safe landing. That's the Fed. Bond market is a little bit less optimistic than the Fed. Bond market's currently pricing in a Fed rate all the way down to 2.7. Now the current Fed rate is 4.7. So the bond market predicts over the next year that the Fed is going to continue to cut rates another 2%. That seems dramatic. They're pricing in the bond market again, all the people who are making investment decisions, that there would be a recession. So they're a lot less optimistic than IM Global. They're a lot less optimistic than the Fed. The red dots on the screen are this dot chart. And that's where the Fed is predicting rates might be somewhere out there. Every dot represents somebody who has a vote on the Fed. And the green line is where the market is pricing it in. So the green line is much less optimistic than the Fed. And it looks like they think there's a higher chance of recession than does the Federal Reserve. Again, IM Global Partners does not share that view. They view rates will be within a range. And so what you see on the screen here is the upper and lower bounds where they think 10-year treasuries will be, which is basically where they are. IM Global Partners believes the 10-year treasury yields are range bound over the next 12 to 15 months. And outside of a recession, they don't believe there's a significant benefit to owning longer duration bonds, such as investment grade corporates or these high yield bonds that I started out by talking to you about. So in that portion of their portfolio, you'll see many of the holdings that we currently own on this chart here. On the horizontal axis, you're going to see a word called duration, which is a measure of bonds' riskiness, their sensitivity to interest rates. And on the left-hand side, you'll see their yield, and the yield is what you get paid by owning the bond. The red dot that you'll see in the bottom right-hand corner, at least relative to the other dots, is the average bond in America. And you can see that the current holdings that IM Global Partner recommends that we invest in provide more yield and less risk. Generally speaking, that's a good thing. That's a good thing. So if you have bonds invested with ANI Wealth Management, you likely have an allocation similar to what you see on the screen, taking a little bit less risk than the average bond, providing a little bit higher income than the average bond. And these are the largest bond holdings that we have here at ANI. That's the IM Global Partner research on bonds. The next category are the alternative investments. If you remember way back where I began, the worst performing investments over the past 12 months were the alternative investments, but they continue to recommend that we hold these investments for the three reasons that you see on the screen. The left-hand side, you can see how these alternative investments as a category did during the Great Recession. They're the little blue bar. The big negative, kind of greenish color. Boy, colors are not my thing. See, what color is that? Teal? Teal green color, says my lovely wife with much better eyes than I do. That was what the markets did. That was the equity markets during the Great Recession. I'm sure we all want to forget that, of 2008. And the other one, the orangish color, is bonds did during that crash. The second period was COVID. You can see that the alternative investments at least held their own during the COVID crash. And the third one, the most recent one, was when the Fed raised interest rates. For that chart, that was the fastest rate increase that one of the fastest in history, certainly since the Reagan era. And those alternative investments did significantly better than the other two and actually rose during that crash of 2022. IM Global Partners, this is the best slide, predicts that equities will continue to do well. In fact, they're predicting that the rally in equities will broaden out outside of just the S&P technology sector, these mega cap companies, the Magnificent Seven. Their portfolios have a meaningful exposure to many of these strong performing mega cap technology companies, which has benefited the portfolio performance. However, IM Global Partner remains balanced, owning large cap value, smaller cap US companies that are trading at more attractive valuations and offer diversification benefits. In March, for our clients, we rebalanced the equity allocation to increase exposure to higher quality, more attractively valued parts of the US equity market, meaning these value companies and smaller cap companies that could benefit from an ongoing economic expansion. And in large part, if not entirely due, the research you see on the screen, these mega cap companies are much more expensive than the rest of the market. Invested a little bit more in the less expensive investments that look like they might be doing well. Next, I've got two slides with two charts each describing some of the reasons that IM Global Partners is a little bit more optimistic than others and thinks that the trend change may have already begun in the third quarter. The Fed's decision to start cutting rates will likely be somewhat of a game changer, according to IM Global Partners, shifting the market trends. Notably, there is a rotation out of large cap tech into a broader range of sectors and styles. So on the left-hand side, you'll see the trailing returns in the blue chart for the S&P or for the NASDAQ. Obviously, those returns are huge, the biggest bar. Almost as good, though, as the S&P 500 because now so much of the S&P 500 is being driven by these Magnificent Seven companies. They become so big, they're driving that benchmark. And the third category would be an equally weighted S&P 500 that puts as much money in all of the companies in the 500 as they do these mega companies. Over the past year, it's been less beneficial to be diverse than it was over the past 3 months. And so the third quarter, you can see by far the best performing investment was an equally weighted allocation. You can see that orange chart significantly outperformed the rest. And IM Global Partners believes that that trend is likely to continue, that smaller companies and value companies will do better in the future than large cap technology companies. Other areas of the equity market which have lagged and have lower valuations like small caps, value stocks, and international markets also benefited from a broadening of the market in the third quarter. And so you can see here, the orange charts are where the orange bars are where IM Global Partners believes the future lay in the Russell 2000, the small companies compared to the large. The Russell 1000 value in the middle, these value companies that are not high-tech growth. And then the last one, the international markets are the orange bars. And you can see in the third quarter, all three of them are a little higher. And so there's a chance, perhaps maybe, that'll continue. Certainly our investments that are with IM Global Partner Research would benefit if that trend continues. All right. Foreign stocks, not to be dissuaded, are still cheap. This is a chart that I've shown for years in these presentations. The global equity allocation from IM Global Partners is now neutral. It's not overweight emerging. It's not overweight international developed. That said, given their lower starting valuations, the 5-year forecast from IM Global Partners expects high single-digit to low double-digit returns for international equities. Again, I'm sharing with you behind-the-scenes information because I've never seen this company as optimistic as they were at the end of the third quarter. Now, there's this thing called the election that just went through, so I couldn't get through this presentation the day after the election without describing it. And so let me just say that it really doesn't matter. And as much as it hurts me to say that, it also really doesn't matter. Within the U.S. presidential election, we want to reiterate our long-held view that portfolio positioning should not be guided by an analysis of longer-term risks and rewards, not election outcomes. We recognize it's natural for investors on both sides of the aisle, especially today in America, we're so polarized, believe that an election outcome could have a big impact on the financial markets. This intuition, however, is not supported by the data. And here's some evidence on the screen And the red periods of time, or the pinkish color, is when a Republican was president. And the bluish periods of time are when a Democrat was Republican. And in all periods of time, the chart moves from bottom left, top right, with no predictive value about how much it would move, regardless of which party was in charge of the executive office. So please bring your questions at the end. I've got a few more slides on that if you like. But that's the bottom line, that companies are going to be managed regardless of who's in charge. In fact, it would be a dangerous decision for us to make a decision to invest in a company that would benefit only if this candidate was elected or that candidate was elected. It would be impossible to predict. All right, so let me show you some captivating slides from Capital Group, I hope. This is a company that's new to these slides, but their slides are so good to this presentation and research that I wanted to share them with you. The first view that they share, that many of you who have had Capital Group or American funds investments over the years will already know their research and their process. But some of you, because it's new to this presentation, may not know. The first thing that they believe, that company, one of the world's largest money managers, believes, is that dividends are a good place to be. Stocks that pay dividends are a good place to be. And in over the past 97 years, almost 100 years, in fact, dividends have provided 37% of the total return of your investments in the stock market. So if you get a dividend every 3 months, 6 months, it could be monthly, but usually it's 6 months, then that return increases and helps you. But over the past few decades, it hasn't been that way. In fact, since 2020, it's been 16% of your return. And since the 2010s, it was only 14% of your total return. The rest of your total return in your equities came from the price appreciation, the growth of the stock itself. Historically, dividends have provided downside cushion during difficult periods, have been a consistent source of return in advancing market environments. Over the past decade, the contribution from dividends hasn't represented as large of a portion of total return as it has over the 100-year period of time. And that may be likely to change. The forward-looking guess from Capital Group is that dividends will become, as they were in the past, a bigger part of your total return. And so it might be something to talk to your investment advisor about. How are you benefiting from that? The right-hand chart, the line graph, shows you some of the reasons why they believe that, and that's called the PE ratio, and that just says that the price for every unit of earnings, the P over the E, shows that these equities are cheap, less than their average price. As many of you know, when you buy things on sale, you get a better value. So that might be part of the reason why dividends could be a good grower. Here's some more dividends. In fact, you're getting them all around the world. On the left-hand side there, you can see some of the largest dividend payers in the United States. And on the right-hand side, although the font is terribly small, dividend payers are that top left-hand bullet, providing greater returns in history and with less risk. Broad range of business sectors in the U.S. that have tended to pay higher dividends, you see their prospects improve as legislation for increased capital spending has been approved recently. Companies are exploring new opportunities and ways of doing business that may help the dividend landscape. Many companies betting from this increased spending look to maintain or increase their dividends. This trend has provided investment opportunities for investors with income needs. Anybody here have an income need? That's a good news. When we look at the dividend characteristics of an equally weighted global universe of companies, we see that the average dividend grower has produced higher returns and lower volatility than the average company in any other segment. Those good opportunities, according to Capital Group, find dividend payers in the U.S. and all around the world, especially if they're growing their dividends year over year. Let's shift the conversation away from dividends and over to how Capital Group views growth. They're a company that doesn't view growth as a style. They view growth as total capital appreciation. That's a little different, unique to that company. Although some of the Capital Group analysts see long-term opportunities in some of these large cap tech companies which have killed it over the past year, they think that might not be the future. It's important to note that there are many other places where Capital Group thinks investors should maintain diversified exposure. The left-hand side shows that duality. That's the same PE chart that I showed you before, according to Capital Group. Or if you bought a tech company today, on average, you'd be paying $30 for every $1 of earnings. But if you bought a company from any other sector in the S&P 500, you'd buy it for a third almost that price. Big sale. The flip side is that other parts of the market may offer good investment opportunities, and Capital Group believes investors should remain flexible and invest outside of just growth. The right-hand side shows what's happened recently in the past quarter. You can see that the Magnificent Seven's earnings growth is that huge bar that went all the way up. Year-over-year earnings growth, over 56% growth in these huge technology companies. But more recently, it's come back down to earth, while the rest of the earnings for the rest of the companies in the S&P 500 continue to grow. So given that, there may be an opportunity to invest, according to Capital Group, outside of just the companies that have done best recently. So a little bit more, seeking growth behind the Magnificent Seven, outside of the Magnificent Seven. There are pitfalls to owning a concentration of just the Magnificent Seven equities. The question for investors is, what else is there? The left-hand chart shows that the market value of the next 50 companies in the S&P 500 is the same market size as just the top 7. And all of these other companies, like financials and healthcare, what we used to think of as huge companies and are still enormous, are more diversified, have more earnings, more profits, and perhaps more opportunities for growth. The right-hand side zooms in on 3 of the sectors that Capital Group likes. I'll dive into that just a little bit. The font is a little small, but you can see the right-hand side shows the Magnificent Seven and the remainder of the S&P 500, but the 3 sectors on the furthest right are aerospace equipment, biotech, and then semiconductor materials. Think of the semiconductor materials as the picks and shovels for the artificial intelligence movement, which is driving the growth of the Magnificent Seven, which is driving NVIDIA to be maybe temporarily or maybe permanently the largest capitalization company in the world. The Capital Group names a couple of individual companies underneath of there, which they like. This is not our opinion, it is theirs. But these are good ideas. These are good segments. These are good things for you to consider as you think about growth going into the future, because the next 10 years may not be like the past 10 years. It's understandable why the U.S. has outperformed the rest of the world. On the left-hand side, you can see the annualized return for S&P 500 companies over the past decade has been over 12%. The same return for international companies has been only 5%. That's the past 10 years. What's the next 10 years? Well, Capital Group is saying we're at a pivot point. It's hard to time it exactly, and it's easy to understand why the U.S. did so much better. We are the world's leaders in things like artificial intelligence, and over the past 10 years, U.S. companies have changed the world and continue to do better. The next 10 years could be different, not that the U.S. might not lead, but because the rest of the world is so much less expensive. And for the 4 reasons you'll see on the board, these things might change. 3 of the 4 imply that international investing could be a good opportunity. First is earnings growth, driven by high growth sectors in the U.S. such as technology, biotech, and communication services, and they're not as well represented internationally. So if that were to continue, obviously the U.S. would do better. But the other 3 are definitely in favor of international investing. The first is valuation. We've talked about that already. The top right-hand bar there shows you that the rest of the world is a lot less expensive than the U.S. We'll have another slide on that in a minute. The third, in the bottom left, the dividends from international companies are significantly larger than U.S. companies. So if you're looking for income from your equities, there's great opportunities outside the U.S. That's a favor, and that's a reason to think about other than U.S. companies. Take a look at the headwind in the bottom right. That's the currency. So as the U.S. dollar increases in value, all these international companies decline by the same percentage. And for the past decade, that's averaged another minus 1.8% per year on that. We may be at a currency changing point where the U.S. dollar may not continue to strengthen. And that's what Capital Group's arguing with this wonderful chart here. That currency changes happen over long periods of time. So this chart goes back to 1970, right before the U.S. released itself from the gold standard. And once the dollar started floating, it declined in value. So on the left-hand side, you'll see it decline. And on the bottom of this chart, you're going to see a big arrow up. What that green arrow is showing is the relative returns. The relative is a hard word to say today. relative returns of international equities compared to U.S. equities, and they did really well for a very long period of time. And then when the dollar strengthened, generally speaking, international did worse. You can see that long trend change continuing over long periods of time over these more than 50-year history you see here. You can see most recently a big outperformance from the U.S. companies relative to the international companies. In large part, Capital Group is putting the correlation here because of the dollar. If you have the inclination that the U.S. dollar might not continue to appreciate relative to the rest of the world, then you might feel a little bit more comforted in putting investment dollars into international companies. Should the next decade bring U.S. rate cuts, the dollar may decline. A broadening market, again, the dollar may decline. And it could also mean a very different environment for international equities relative to the U.S. I found those slides fairly captivating. If you enjoyed that, we'll continue to use their research in our portfolios. They're becoming an increasingly bigger part of the work that we do here at ANI Wealth Management as they come out with some pretty innovative investment products that we're using. So our third research partner, I love these guys. We've used them for a long time because they make all that complicated stuff that I just talked about easy. They divide everything I just talked about with their own forecasts into 4 charts. What you see on the screen, 4 big boxes. The first is the behavioral box. This is where Athena Invest has their patent. And you can see the box on the left-hand side is in the green, and that means it's good. It's either green, yellow, or red. And so their behavioral indicators are good. In fact, they're excellent for small cap U.S. companies. So it sounds like they're in agreement with both IM Global Partner and Capital Group. And it might be something that the markets are agreeing with today, the day after the election, for small cap U.S. companies. The second category is in the yellow, and that's the economic indicators. And what Athena Invest has done is boiled down all the economic indicators into 2. And these are 2 academically, rigorously proven to have some predictive value for equity markets. And one measures the goods activity and one measures the service activity, neither of which are stellar. So Athena is not nearly as optimistic about the economy as IM Global Partners is. And so that's a note, right? That's not all green. It's not all good from all the research partners. That's why we have a diverse opinion, and that's why we have a diverse portfolio. The third category is actually in the red, and that's measuring the valuation of these companies, which isn't surprising. Like we talked about before, the average U.S. company is way up, and these technology companies are really expensive right now. Their PEs are off the charts high. And so when that happens, it's really expensive to buy more of these companies. You're at higher risk when you pay a lot for a stock investment. And so the fourth category is all green, which is almost always the inverse of the third because trend of the market has been up. It's all green. And when a trend starts, it's likely to continue and not reverse. And so you can see, by and large, if you just took back and looked at the colors, it's pretty good. And some of it's excellent. And some of it's expensive. Maybe you want to just keep that in mind. It's a nice, simple way to view this. And this is always available on the AthenaInvest.com website if you ever want to see how they're viewing the world. All right, so those conclude my prepared remarks. In summary, things are good. And there's still a lot to worry about, but it's not your portfolios. And I sincerely hope that you take from this a message of optimism and confidence, but also remember the message that we've been delivering to you every quarter, several quarters now, that even though all this news is terrifying and there is a big wall of worry, that we've been hanging in there, we've been keeping our eyes on it, and things have continued to look good, just like we thought they would. And that might be a message you can take home and say, whew, I'm glad they're on it and not me. And maybe you have a friend or two who might also benefit from that insight, because our goal is not to try and be right about the markets, but to be right every time, with absolute certainty about your financial plan. And that's the way we face the world of uncertainty, and that's the way we face the wall of worry, and that's the way we look at things like 24 hours after, not even 24 hours, maybe 12 hours or 9 hours or 10 hours after the election was decided. So these are some of the resources we have. You can scan that barcode here and send some of your friends to it. We get the weekly newsletter. We got twice weekly or every 2 weeks, twice monthly podcasts that I do, especially for business owners. And then we have seminars and events like this. We just got a lot of things that we're trying to provide you. Our next event is December 9th. It will be here, or December 6th. December 6th. I don't want to send you here on a Sunday or Monday, right? Here on a Friday night, December 6th, the first Friday of every December, we hold our big party. There'll be over 100 of us here, and you're all invited. So please join us here at ANI Wealth for the holiday party. It'll be a blowout party. Please do RSVP with us, and it goes from 4 o'clock until whenever everybody leaves. If we have a snowstorm like this, like we had one year, we did have one person spend the night in the office. Yeah, I don't recommend that, but we do have wonderful benches, and we do keep the heat on even when nobody's here. So you can do that if you like. And then we'll do our next quarterly investment update in January. So that'll be January 16th. It's a Wednesday, I believe. Maybe it's a Thursday, but it'll be at 11:30. And so we'll give you the end of year update and our partners' forecasts for the next year. Without further ado, I wish you all the best. And again, thank you for the trust, confidence you place in me and ANI Wealth Management.